As you can see here, at 9 a.m., which is in about 15.5 minutes, we have Canadian Interest Rate Statement coming out of Canada. They release interest rate statements once per month, and usually if they raise the rate, it's to curb inflation and growth, and if they cut the rates, it's to spur inflation and growth. As you know, for example, in the United States, the housing market has been doing very badly, and it's been kind of dragging the economy along with it. And there are a lot of speculation that the US will cut the rates, simply because as the country cuts rates, mortgages become more affordable, borrowing becomes more affordable, so money becomes cheaper. Because of that, as people have to pay less for houses because of, let's say, most people have adjustable mortgages, as mortgages go down, people have more income that they do not have to pay for interest in houses, and they spend money, and by that the economy starts growing again. On the other hand, for example, in Canada, we've seen very strong growth, very strong inflation. The prices have been going up very rapidly, and on their horizon are interest rate hikes in order to try to curb inflation, which they're trying to keep under 2% year on year, which has been above that. Excuse me. Anyway, yeah. So when the country's inflation gets out of hand, when the economy picks up velocity and starts growing very rapidly, and partially, Canadian economy many times depends on the cost, on the prices of natural resources that have been up, because they're a big exporter of oil and some other natural resources. So because of oil has been picking up in price, and some other things, and the price on some other natural resources have been going up, it's been boosting partially the Canadian economy. It's been boosting employment, along with some other things. The housing is relatively bullish there, especially on the western side of Canada. So the inflation has been going strong, the growth has been going strong, and there are a lot of talks now, more than ever, of Canada needing to raise interest rates. Now, about 4 years ago, the inflation kind of got out of control, and Canada hiked interest rate to everybody's surprise. So it has happened before that they surprised. As you can see here in the trade plan, prior number was 4.25%, and SNS consensus for today is 4.25%. It's pretty unanimously expected that the interest rate will stay unchanged, but there is a possibility, higher than ever, that they may do a surprise hike. Some people on one side of the argument are saying because of the speculation of high inflation and growth, there has been a lot of strength in the Canadian dollar. It basically broke 30-year high versus the US dollar, and that by nature usually curbs inflation and curbs growth. And most of the consensus is that the Bank of Canada would probably want to look at one more consumer price index reading and one more employment report before making the final decision whether it's necessary for them to hike or not. Most think that Dodge, the governor of Bank of Canada, would warn people with some comments that he would hike a rate. And last time Canada raised interest rates, not raised, announced interest rates and changed, Dodge made some accommodating comments saying that inflation is just a tick up, and he was very kind of dovish, wasn't really talking too much about the need to hike rates. So the large consensus is that if Canada does raise rates, it will be later this year, and Dodge will start speaking about that a lot more. So even if the rate is unchanged today, the comments that are accommodating the release may be very much hawkish. If hawkish means kind of aggressive towards interest rate hikes, and hawkish may mean that they don't necessarily say that they're going to hike, but they make comments such as inflation is rising to an uncomfortable level, etc. Well, another reason why mostly the economists think that the Canada will not hike the rate is because in the beginning of the year, Dodge has predicted that the inflation will stay kind of high at 2.5% in the first quarter of 2007, but towards the end of the year it should moderate. But it doesn't seem like we're already into almost second half of the second quarter, and it doesn't seem like inflation is moderating. It's kind of going up, so it's breaking the predictions a little bit, but not decisively yet. They'd want to probably see June's report for May to really kind of make that final decision. So in this particular case, as you can see, according to the trade plan, if they hike the rate to 4.5%, it would be a deviation of plus 0.25 or more, and it would be a possible sell on USD CAD. Obviously, the reason it would be a possible sell is because when we go short on USD CAD, we're going towards Canadian strength, and when we go long, we're going towards Canadian weakness, because CAD is second in line there in the USD CAD pair. And of course, if for some reason there is a cut, which would be completely ludicrous, by minus 0.5, it would be a possible buy in USD CAD. Me personally, I've set my secret news weapon on the Owanda account for two different pairs, USD and Euro CAD short, and to be honest, I didn't even set the clicks for a long. I don't even want to consider that, and I don't want to even click that in case there's some mistake by a news service or something. I mean, cut in this particular situation is pretty much impossible. As you can see here, I put just one trigger here. I mean, there's probably a possibility for just a quarter hike, and I put regular 30 pips limit triggers. So I'd be using a limit order on my MB trading account, 30 pips, 30 pips away, and if I cannot get with it filled within those 30 pips, I'm not going to get filled even on this interest rate statement. On my Owanda, I think I'm just going to use market orders without any bounds, because such surprise would be very big, and I think we should see a continued move towards Canadian strength. Now, it's very possible that, and most likely, probably 95% chance that Canada will not hike the rates, and I'm going to have to look at the comments accommodating the statement. And depending on what those comments are, I may give kind of an after spike, or whatever you call it, trade. If the comments are clearly hawkish, we may go short in USD CAD. If for some reason Dodge is being kind of dovish or not hawkish, kind of being neutral, even after such high CPI readings, we may go long in USD CAD. If he's kind of neutral and he's saying, well, yes, inflation is ticking up high, but we got to look at more data before making any decisions, most likely that would be a no trade. We really have to see some clear tone. As you saw on the USD CAD, probably when the market opened on Sunday, we saw some weakness in the Canadian dollar. The Canadian dollar weakened by about